Well, history tells us that the last people to understand what is actually happening to their currency are the users, the people. I mean, this is particularly evident in the inflations in Europe in the 1920s. I mean, Germany, Austria, Hungary, Poland, and Russia, whose currencies basically collapsed. Um, and I can understand that. I mean, the narrative is it's got nothing to do with basically goes all the way back to the failure of the Bretton Woods system. I mean, that failed because the Americans were already running deficits. They were expanding, in effect, expanding the quantity of dollars in circulation, but more importantly, they were expanding it not so much in production, which had been the engine, if you like, for post-war economic progress, but more into other things like, the war in Vietnam, before that, the war in Korea, the building of military bases all around the world. And, so all this sort of waste of money. And of course, because it went in that direction, the dollar started being undermined because a hell of a lot of people ended up with dollars that they didn't want, which actually is interesting because we can come on to that story for today, I think. But this particularly led, I mean, if you think France, Indochina, which is Vietnam, of course, the French ended up with quite a lot of dollars that they didn't want. And General de Gaulle, advised by, I can't remember his Christian name, Roof, who was a
Jacques,
very, very,
Jacques,
Jacques, that's the
Jacques,
one. Thank you very
yeah.
much. He was, he pointed out actually that there was no way that the dollar could stay at $35 an ounce, and therefore you've got to get rid of these dollars, which is what France did. Germany got round this one by accumulating gold at the New York Fed. Um, I can't remember how much they had there, but I mean it was a huge amount they had. And of course, recently we discovered, like what, 10 years ago or something, we discovered that there was a slight problem with the quantity of gold actually held by the New York Fed on behalf of the Bundesbank. I mean, the problem is that the Americans have been dishonest about currency and gold, really, from the start of the Bretton Woods system. I mean, let's face it. And so when it broke down in 1971, I mean, that was just part of a process, if you like, of currency destruction. It was quite clear to the U.S. Treasury, et cetera, that in 1971 the run on the U.S. Treasury's gold stocks by foreign governments was going to threaten the whole system, so they had to suspend it. Note the term suspend.
Depends, yeah.
Still suspended 54 years later. So that, it really all started from there.
Before the 20th century, governments largely avoided direct economic manipulation, believing markets corrected themselves faster than politicians could. That philosophy faded as intervention became fashionable. Early warnings appeared in the 1920s, but the real shift arrived under Franklin Roosevelt, when currency management, price controls, and state-led planning became normalized. From that moment on, money ceased to be a neutral measure of value and became a political tool. Each new crisis justified deeper interference. Over time, economic discipline disappeared, replaced by debt-fueled growth. The consequences were delayed but inevitable: distorted markets, rising instability, and currencies increasingly divorced from real value.
But then there's been another development, and that is that governments have moved away, and this really started with FDR, moved away from, let's say, just protecting the nation, protecting the nation's interests, making the laws, to micromanaging the economy. I mean, before then, what happened was that, there was a general acceptance by the political class that if they meddled in economic affairs, they'd only make things worse. And so you had the Depression in 1921, which only lasted 15 months. Why? Because government just stood back. It let interest rates soar to reflect the risk, if you like, the lending risk. Um, It didn't change the gold standard from 20.67 or something. I mean, that had been de jure from 1900, but in reality, de facto from the 1850s. So, um, you know, just don't get involved. And you then had silent, cool Coleridge, whose business secretary was Hoover. He said Hoover was a great interventionist. Silent Carl said, "That man's always giving me advice, and it's always bad." He was so you could see that was the moment when intervention started becoming, the popular thing. And of course, FDR continued that in spades. And of course, they've been screwing up the economy and money, particularly money, ever since. So what we're seeing now, I mean, from 1971 to today, we've had a pure fiat currency system, no longer hiding behind gold and using it if you like. Well, we've got huge, great gold reserves, so it doesn't matter that some of
Yeah,
that
we've not
runs out.
used it as a kind of Wizard of
Yeah,
Oz
yeah.
style, to bring that analogy in, have you? We've kind of been not been pretending anymore.
No, exactly. And of course, what happens over the course of every fiat currency is it's a license for the ruler or the government to spend, 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 spend. And you devalue the currency, you debauch the currency, and eventually, and this is the key to the ending of the fiat currency system, people begin to lose faith in its value. And that is what we're now seeing. And this is really why the gold price appears to be rising. We can't actually separate out to what extent it's the gold price rising and dollars collapsing. But basically, over long, long periods of time, the gold price, in terms of its purchasing power, is relatively stable. Um, so this big change we have seen from the $35 an ounce, which was the suspension price back in 1971, we're now, as I look at my screen, 4,205. That's not gold rising, that's the dollar falling through the floor. And the rate at which it's doing it is now accelerating. And you can look at the other side of this and say, well, it's an accumulation of debt, which of course it is. And today we've got looming problems on the debt. I mean, how is the U.S. Treasury going to finance its debt? I mean, they're looking around about 1.82 trillion excess spending this year, and they've got to roll out existing debt, which is going to be more expensive as a result. So, interest cost, which is a notional figure because they don't actually pay it, they just borrow more. So you can see that this is becoming, if you like, a debt trap, and the debt trap particularly gets sprung when you get an economy that stagnates, because as far as foreign creditors are concerned, they will look at the America's ability, if you like, to cover the interest cost of its borrowing. And if the economy is not growing as fast as the borrowing, then whoops, we're in a debt trap. So what happens to interest rates? They got to rise to reflect the extra risk. What then happens to the credit bubble, which is the other side of debt? Oh dear, we've got a problem. And that's really, I think we're very much on the cusp of the whole thing falling over. Those are the two things to look at, Jan. I think you're looking, you've got to look at where interest rates are going, where bond yields are going. I mean, interest rates, short-term interest rates, the Fed has decided that it's going to, things are getting so bad, we've got to support the economy, we've got to ensure there's sufficient liquidity, et cetera, et cetera. So we're going to get a cut on Wednesday. I mean, that's a given. Meanwhile, of course, the carry trade is financed out of yen, and guess where that's going? I mean, interest rates in Japan are rising, and if you look at the yield on the 10-year JGB, I mean that's now close to 2%. So you've got two problems there. I mean, the Japanese institutions, who are the largest foreign holders of U.S. treasuries, no longer have the incentive to buy U.S. treasuries because, I mean, the reason they bought US treasuries is because their own bond markets yield the square root of nothing. That's now changing. And then you've got the carry trade as well, which is being run basically by hedge funds out of the Cayman Islands and also out of Luxembourg. So, that arithmetic is beginning to go awry as well. So interesting times, interesting times.
With gold removed as a constraint, governments gained unlimited spending power. Debt expanded faster than economic output, turning credit into the system's primary fuel. For decades, this worked, until it didn't. Today, interest costs consume ever larger portions of government budgets, forcing more borrowing just to stay afloat. When debt grows faster than the economy supporting it, confidence becomes fragile. Foreign lenders begin to reassess risk, demanding higher yields or stepping away entirely. This is the classic debt trap. As borrowing costs rise, credit bubbles strain, and the illusion of stability starts to crack, often suddenly and always painfully.
I mean, basically, the thing to watch is bond yields and the equity bubble. I think those are the two things to watch. The disparity in terms of valuation of the equity market, I mean, talking American equities here, is greater than it has ever been in history. We don't have statistics for, or at least I haven't managed to achieve statistics for 1929, but I would guess it's worse than that. It's certainly considerably worse than the dot-com bubble in the year 2000. And this disparity in valuation is so enormous. It's something that happens, Jan, when you get the sort of cycle of markets. You find that the final move in an equity market occurs when things are looking good in the economy and there is demand for credit, and the result is that bond yields have begun to rise to reflect that demand for credit. So you get, for a brief period of time, you get this sort of markets moving in sync, as it were. Then you will get a pause because obviously things get a bit overheated in the economy, interest rates have risen a bit, and all the rest of it. So things sort of pause, if you like, in the bonds. But in equity markets, they probably continue rising. The problem then is that bond markets begin to reflect risk because the economy is actually going towards into recession as a result of the higher interest rates, et cetera, et cetera. So when you get the second surge in bond yields, that is the killer as far as equities are concerned. It's that second surge. Now, we've had the first surge, we've had a consolidation in bond yields from about 2022. That now looks like it's changing. If you look at the JGBs, they've started soaring. Look at the German Bund, the 10-year and even longer ones. They're looking like breaking out into new high ground. There are various sort of bond markets like that indicating that things are coming really to a close, if you like, in the sense of bond yields consolidating before they move higher. And when they move higher, that's the bit that breaks the equity bubble. So those are the two things to look for. I mean, the equity bubble could well burst without those bond yields moving higher first. We don't know. I mean, there's so many things around which could trip it up, but those are the two principal things I think you've got to look at.
Market history shows a clear pattern. Late-stage economic cycles often feature soaring asset prices alongside rising bond yields. At first, markets tolerate it. Then comes the second surge in yields, when risk becomes undeniable. That moment has historically marked the end of equity bubbles. Today's valuations exceed even past extremes, rivaling or surpassing the dot-com era. Meanwhile, global bond markets are stirring again. If yields resume climbing, leveraged assets face pressure from all sides. With stocks widely used as collateral, falling prices can trigger forced selling, accelerating declines. Once confidence breaks, liquidity evaporates faster than policymakers can respond.
I think the way in which this will pan out is that, first of all, you will get an equity market crack, as it were. Now, whether it takes 3 years, as it did between 1929 and 1932, or whether it takes 10 minutes, I mean, only time will tell. But when that happens, bear in mind that there is an awful lot of bank lending on the back of collateral in the form of stocks and shares. And that, as that collateral value starts declining, the banks will basically liquidate those positions. So you'll get a falling market with banks liquidating the positions. On top of that, you've got another problem, and that is that according to the US Treasury's tick figures, foreigners own over 20 trillion of US equities. And that's part of a total of 44 trillion of dollar deposits, short-term debt, and also long-term debt, including US Treasuries. But half of that, roughly, just less than half of that, 20 trillion, is invested in equities. Now, we know what foreigners do when a market goes sour on them. They get the hell out. Now, I don't think they'll realize 20 trillion. They might, if they're lucky, realize five as the whole thing falls down around their ears. Okay, so that's the background to it. Now, what do the authorities do? Well, they've already started with, well, I mean, they will have next month, already started with QE. They've gone from QT, which they've dropped. They're going into QE. What that basically means is that the Fed will be in there buying assets for cash in the form of base money, if you like. I mean, particularly in the form of adding to bank deposits. QE, we're going to see QE like they've never done before, simply because they've got to try and stop this happening. But it won't work. And of course, the problem here is you've then got to think about the knock-on consequences of that. When you get this massive expansion of the quantity of central bank credit, which is basically currency, what you're going to get is you're going to get the gold price rising, because the gold price is going to tell you, oops, there's going to be huge, great inflationary consequences of this. Now, I don't think anyone is looking at the inflationary consequences of the bubble imploding. And that is going to be the next stage. And not only that, but the smart money, which is central bank money, they can see this. They can see this, the increased likelihood of this happening. And this is why they have been buying gold. They're not buying gold, they're getting the hell out of credit. That is the point. And they've been doing this for the last 4 or 5 years. Now, you touched on sort of developments, if you like, elsewhere. If you look at the Chinese situation, then they know this is going to happen. And I think particularly when Trump came in, they thought, this is a disruptor. He is going to destroy the entire financial system, the dollar-based financial system. So we've got to get a move on to protect our currency. So the Shanghai Gold Exchange opens vaults in Hong Kong and also in Saudi Arabia. Saudi Arabia being, the biggest oil supplier or energy supplier. And I have no doubt that the Chinese have been talking to other, if you like, the nations where the Chinese diaspora is around Southeast Asia, saying, right, we will happily exchange yuan for gold or whatever. So you can take yuan in the knowledge that it'll be exchangeable in gold. That is the whole point about opening SGE vaults outside China. What China does not want to do is to be blamed for the collapse of the Western financial system. So she will go along with it to the point where she feels she's got no option but to protect her own currency by fixing an exchange rate between the yuan and gold. And we are looking at trade for the whole of the Shanghai Cooperation Organization. We're looking for the whole of BRICS and all the rest of it. I mean, the idea that, the unit which has been promoted, forget it, that's a nonsense, absolute nonsense. China will effectively replace the dollar for nations representing over 70% of the world's population. That is the consequence of the currency destruction, which we're likely to see in the wake of the equity bubble in America bursting.
When crises erupt, authorities reach for the same tool: monetary expansion. Quantitative easing injects liquidity, but at the cost of currency credibility. Each rescue erodes trust further. Gold, however, reacts differently. Over centuries, its purchasing power remains remarkably stable. When gold prices surge, it is not gold changing. It is the currency weakening. This is why central banks have been quietly accumulating gold for years. They are not chasing profit. They are exiting credit risk. This silent repositioning signals a loss of faith in fiat stability, long before the public recognizes the danger unfolding beneath the surface.
Well, history tells us that the last people to understand what is actually happening to their currency are the users, the people. I mean, this is particularly evident in the inflations in Europe in the 1920s. I mean, Germany, Austria, Hungary, Poland, and Russia, whose currencies basically collapsed. Um, and I can understand that. I mean, the narrative is it's got nothing to do with the quantity of credit or whatever. It's all to do with those nasty capitalists, demanding higher prices for their goods, sort of thing. And that narrative is the one which everybody understands. It's wrong, but that's what they believe. Um, and of course, the first people to realize that a currency is overvalued are the foreigners, and they're the first to sell it. You will find also that a few enlightened investors, I mean, generally, let's say old money, let's say, big family offices, let's say some of the smarter institutions will see this and they will hedge out of it. Um, but basically, all the language about what inflation is just totally wrong, and it's misleading everybody. So the public just don't understand what is going on until very, very late in the game. Then you will get the rush. I mean, the Austrian economists called it the if you like the crack up boom. Whereby the last moment, the dying moment of a currency, when people realize that it is the currency going down and not prices rising, what they do is they get rid of all the currency they've got to get into goods before the currency actually finally collapses. And that's the sort of, if you like, the crack up boom, which marks the end of any credit value in a currency. So people are going to suffer from this, I'm afraid, and they will learn the lesson late. I mean, part of what you're doing and what I'm doing is to try and educate people about these factors and save them, if you like, from all the propaganda, the wrong propaganda that the establishment has put out about the value of the currency and all the rest of it. But we're just going to scratch the surface. And I don't know about you, but I find that most people I talk to about this sort of thing think I'm nuts.
History shows that ordinary citizens are always the last to grasp currency collapse. The narrative blames greed, shortages, or speculation, never money creation itself. Foreign holders move first, selling depreciating assets. Institutions hedge next. Only at the end does the public rush to convert cash into real goods, triggering what economists call the crack-up boom. At that stage, confidence evaporates entirely. Prices don't rise. Money dies. Today's warning signs are unmistakable: debt saturation, asset bubbles, and accelerating monetary expansion. Education may not stop the cycle, but understanding it early can mean the difference between preservation and loss.